All right, why don't we kick this off? So today, thank you for joining, by the way. Today we are going to, I believe this is our last or second to last of a January series on getting the year off on the right foot. And then February, I don't know if the invites come out yet, but February we're going to do a number of webinars on ETFs. So hopefully people will think that is exciting as well. But before we get started, our general advice warning, anything you hear today is general advice. Obviously, I don't know anything about you. I can't offer personal advice. If you're over in New Zealand, you want a copy of our FAP, you can go to our website, morningstar.com.au to get that. New Zealand regulatory authorities would encourage you to speak to a financial advisor in order to get personal advice. So I'm Mark LaMonica. As I said, we're still going through our new year, Get You Off on the Right Foot series. And today we're going to talk a little bit about going back and looking at portfolio performance, because of course that's something that a lot of people do early in the year. And we're going to walk through hopefully some practical tips about how to do this right and make sure that this review is actually beneficial for you. So I'll go through some examples. We'll look at a couple of things. We'll talk about the theory first, look at a couple of things on the website. But of course, if you have any questions along the way about anything, just feel free to put those in the Q&A or the chat, and I will get to them. All right, so let's get started. You can, of course, listen to our podcast, follow us on Instagram. We're going to talk about portfolio review. So let's go back and let's start at the beginning, of course. What is the purpose of going through a portfolio review? So just a couple points to make at the beginning. So it is good to spend some time at set intervals, and we'll talk a little bit about timing. So annually, semi-annually, for example, to make sure that you are still on track with the strategy that you put together to achieve your goals. So we talked a little bit about investment strategy and goals in earlier webinars this month. Those are all available on YouTube, as this will be after we finished. So you can go back and watch those if you'd like, or send me an email if you need a link. But once again, we want to stay very focused on goals. We'll talk a lot about goals today, and then of course the strategy we've designed to accomplish those goals. The other time that's good to do a portfolio review is if your circumstances change. And that, of course, can change that strategy. Potentially your circumstances also change your goals. So good time to revisit. But really what we're looking for here is not to use this necessarily as a mechanism to go out and do a bunch of things, but instead to affirm and build confidence in your strategy, because ultimately it is the confidence that you have in your strategy that will allow you to stick with it over the long term, which is really, really important. Switching up your approach and your strategy constantly without a real driver for it is not a good formula for achieving your goals. So that can lead to all sorts of bad outcomes. That can lead to, of course, over trading, churning your portfolio, which is not a good thing. So yeah, consider that. So when we say periodic, we mean periodic. One of the problems with looking at your portfolio all of the time is, of course, that can make you think that you need to do something. So we, of course, have this natural action bias as humans. We've all heard about this. This is not exactly groundbreaking stuff, but back to our caveman days when we had the whole fight or flight mechanism. Well, we apply that to a lot of different parts of our lives. And so we feel like we need to take actions in response to just about everything. And we don't want a lot of tinkering with our portfolios. We do want to make sure that we have something, and the changes we made are rational and thought through, or as rational as we can make them. And what a lot about today will be is we want to get beyond that surface level review of quote unquote performance, because that, of course, is a big driver for us to take action. We feel like we did not perform well, we underperformed, whatever that means. And we'll talk about how you can assess that. But this is really the goal of this process. And so, as I said, it doesn't necessarily matter when you do this. If you want to do this every April, do it every April. But naturally, people start doing this a lot in January because it is an easy time to look back and reflect on how you did during a calendar year. So that is around the timing of why we are doing this now. Okay, so we want to start with goals. So I talk a lot about, and we talk a lot about at Morningstar, of having a goals-based investment approach. And really, quite simply, once again, to repeat what I've said a lot, that means that we're all investing for a reason. Now, maybe you think your reason is having the most money possible, but that's not necessarily your reason. And that is not a great approach to take, because once again, if you have some ill-defined goal, like being rich or having the most money possible, it naturally leads you to make poor decisions. It naturally leads you to chase performance. And this may seem logical, but a lot of people will take the approach, okay, I want the most money possible. I'm going to go back and look at what performed the best over the last year, and I'll simply move my portfolio into that. So whether that be a strategy or whether that be individual investments, a lot of people take that approach. And the problem that we run into then is a lot of investments exhibit reversion to the mean, which simply means that things that perform well in one period don't necessarily perform well in the next period. Really what we want is a long-term view. I actually wrote an article on that, if anyone read it, on Friday, talking about why that's important. So I won't repeat that, but if anyone wants a copy of that article, send me an email. So I've used a couple tools that we have and took some screenshots of them in Morningstar Investor. But obviously, if you're not using Morningstar Investor, you can also start tracking progress against your goals. And one of the really important things is to look at progress against goals over the long term. So if you are investing for a very long period of time, except for in very specific situations where you are potentially approaching a goal, performance over 1 year is not going to make or break you. So that's why we want to take a longer term view of performance, even if we're doing this annually or semi-annually. So let me quickly just show what I did in here. I took a goal at the top. And you can see very simply, as we talked about with goals, we've got a starting value, we have a future value. We have taken inflation not into account in terms of this example, but you should, because I've not put an inflation rate in there. We've got no additional investments. We've got 9-year time horizons. Those are all the things that we need to figure out a goal. So we need to figure out what is the time period. We need to figure out how much are we able to save and contribute to that goal over time. And that will give us, of course, a return. So very simply, to get from $1.7 million to $3 million in 9 years, we need a 6.51% return. And what we can do then is actually look at the return that we achieved in our portfolio with some context. The issue, and we'll get into this in a little bit, the issue that we run into often is that we are comparing our performance to sometimes nothing. We just have in our head what good performance is or what poor performance is. We are potentially comparing our performance to a benchmark that may not apply at all to what we're trying to achieve and may not actually reflect our portfolio at all, and judging that good or bad. And based on that judgment of whether it's good or bad, we're then making actions. So we'll talk more about performance later. So I'll skip by this, but what you can see here is this goal was established in 2020. We've got a portfolio that actually went back to 2006, and we can see the annualized return. So in this case, we can see that the annualized return over that longer time period, remember, even after a poor year that we had last year, we want to look over longer time periods. That annualized performance is significantly outpacing that goal. And we can see the contributions, of course. So where is this coming from? Between capital gains, so that's how much the individual holdings in the portfolio have gone up in this case or down, where we're getting it from a currency perspective and where we're getting it from a dividend perspective. So this is a good perspective to take because you can actually see what are the drivers of those returns. You can see in here, a fair amount of them came from dividends. So dividends contribute a lot to returns, something that's underappreciated by a lot of investors, especially after we have very strong performance in years like 2021, where dividends, of course, can get overshadowed, but over the long term, dividends are still a big contributor to returns. And if we go back and we look at the ASX 300, for example, something like 50% of returns actually come from dividends. Now, Australia, of course, is a high income market, higher dividends than most other markets. And of course, we get that booster from franking credits, but good to see that breakdown. So you can see what is the source, where are those returns coming from? So what has happened? Well, what has happened, because this annualized return is ahead of the required rate of return, we are actually tracking very well against our goals in this example. So in this example, we are not only making progress towards our goals, progress would just be defined as hitting that minimum required rate of return, but we're actually achieving that, or we're actually exceeding that. So we can also look at our goal, and you can see I've clicked on the other tab on here. We can see with all the goals that are set up in Morningstar Investor, we can see an update on the goal. So basically what that's doing is that is recalculating that required rate of return. It's recalculating it based on, number one, how much money we put into this portfolio. In this case, I set this thing at 0. But if you think that you're going to save $10,000 a year, you're saving $15,000 a year, that is a good thing. But also it's looking at performance. So what's happened? Well, this portfolio has gone from 1.7 million in 2020 to 1.96 million. And this return has actually gone down. So that is a good thing. Now, when you start looking at that required rate of return, that can be a clue, and it can be a rational clue to what you should do with your portfolio. If, of course, that return is dropping as you continue to approach that goal, then perhaps it's an opportunity for you to take risk off the table. Because once again, we'll talk about asset allocation. The more you allocate to growth assets with higher expected long-term returns, the higher your long-term return should be. But in this case, maybe you could take a little off the table. So looking at these two numbers and comparing them can be a very valuable input into any changes you may make. But once again, ground these around goals. And we'll talk about this in a second, but the other really important thing is, of course, to revisit that goal. So over time, and we'll talk about this later, our circumstances may change, and that might adjust our goal. We might adjust our goal simply because as we age, different things could be important to us, and those calculations should change. So it is a good time to revisit that goal. Is that, in this case, $3 million enough? Should I start upping the inflation? So what that inflation will do is that will actually inflate that future value you need. If you're thinking about having a certain amount of spending money in today's dollars, important to include that inflation, but especially after a period that we've gone through, that we're still going through, if you maybe want to change those inflation calculations because you think inflation is going to be higher over the next decade, then maybe that's an opportunity to do that as well. And of course, we want to see, are we getting closer to the date of that goal? And if so, does that also have an influence on our asset allocation? So I want to start with goals. Really important to have that foundation. I know I just keep repeating this over and over again, but it shows where you're actually going, which of course is the only way you can figure out how to get there. All right, let's talk about strategy. So of course, strategy attaches to goals. And strategy can also be influenced along with your goal if your circumstances have changed. So what we want to do, of course, is we want to create a strategy that's different for you, different for me, different for everyone, because we are all different. We have different goals and we have different circumstances that are going to govern the way that we can save and invest. It's a good time to go through kind of a mental checklist of, has anything changed? So we talked about goals. Have there been any significant changes to your investment goals? Have there been significant changes to your financial situation? So a couple things can happen there. So number one, obviously, I put in some good stuff. You, of course, could receive an inheritance from your long-lost uncle who you've never heard of. That's always nice. I don't think it happens very much. But also things around changing job status. So remember, when we're looking at goals, one of the important things is to look at how much we can save for that goal. So if your income's been impacted by anything, hopefully on the good side, maybe you've gotten a promotion, maybe you've gotten a raise, maybe you've switched jobs, but also on the downside. Maybe you've decided that you would like to work less. Maybe you've decided that potentially you're going to go into a different industry that doesn't pay as well. That's all times to go back and revisit this as well. Because once again, as that goal changes, it can also change your strategy. And then, of course, there are just impacts to your life that can affect your finances, becoming a parent, having to care for older relatives. All of these, of course, are unique, and this list can be very long depending upon your personal situation. But that's going to impact two different things. It might impact the goals that you're trying to achieve. It might impact the amount that you need for your goals. And it might also impact the amount you can save, which brings us to our next point. Any of those adjustments, of course, are going to adjust that required rate of return. If you're saving less, you will need a higher rate of return in order to achieve your goal. That could impact your asset allocation and the approach that you're taking. And same things, of course, if you are looking to save more potentially, right? So that can mean you can potentially take some risk off the table or adjust your goal, right? So if you've gotten this great new job where you're compensated more, maybe you want to adjust your goal. Maybe you've gotten used to a different lifestyle and you want to change your retirement goals. And then I put this down at the bottom. It probably should have been first, but your emergency fund. So something that I know is a big focus for a lot of people getting started with investing, but it's also equally important for people that are further along their investing journey. And the emergency fund, of course, is something that we need so that our whole strategy does not need to change if there's an unexpected expense. Right? It's a buffer to actually cover that. But if you do have an emergency fund, potentially have to spend some of it during the year or whatever this periodic time period is that you're looking at, then potentially we see a change there. So you've got a couple questions already, although most of them are from Lisa, who sent me a picture of her freshly shaved summer haircut alpacas, which is good. Well, Lisa read my article. Thank you for reading the article, Lisa. So Lisa says, is it worth considering investing even during retirement? And yes, it can be. So there are all different types of ways we can think about that. But remember that retirement periods can be very long. So the last thing we want to do, and one of the tricky things about goals, is for a lot of people that goal is actually retiring. But then you realize that, okay, well, now you do need to support yourself for potentially decades with your retirement nest egg. So it kind of depends upon what you mean by investing, but it is very important to stay invested. It is important to continue to have those growth assets in your portfolio, given the length of time you have for retirement. And certainly if there is any cash flow coming in, that is potentially more money you can put into your investment account. So I'm not sure if that's exactly what you meant, Lisa, but let me know, and I can include that. And we do have a comment or question from the anonymous attendee saying, your goal details does not include a column for pension withdrawals. It doesn't, and I will say that that is something lacking from it. But yes, if you are in a drawdown period, then that, of course, can impact your finances as well. And there's certain ways that we can look at that. And so if instead of adding and contributing more to a portfolio, we are taking out money from our portfolio, that is, of course, going to impact how much you can grow that portfolio and where you and the investing approach that you may want to take. But one of the bigger influences, I would argue, during retirement is how are you actually going to fund those withdrawals? And there's a lot of different approaches to it. So one thing that we do talk a lot about and we'll continue to talk about is using a bucketing strategy. And that, of course, is rotating money out of the investment part of your portfolio into cash, building up a little bit of a buffer so that you can ride out any volatility we have in the market. So basically, if the markets go down, you do not need to continually sell your investments because you do have that cash portion that you can withdraw from. And then, of course, start refunding that when you're more comfortable selling things when markets are going up. All right, performance. So this is the one that everyone wants to talk about. So let's talk a little bit about performance. So as I said, there are kind of two different approaches that people take with reviewing portfolio performance. And of course, right now, certainly after the end of financial year, is a very easy time to do this because you're getting all of these views and all of this information about performance. So number one, you can get those performance reviews out of whatever you're using to track your portfolio. If you're using ShareSite, there are a lot of reports where you can look at performance. I've talked about annualized performance as we're using it, looking a little longer term, but you'll start to hear about what performed well during the year, what didn't. And of course, naturally, people are going to go and look at the investments in their portfolio. But a couple of thoughts about performance. So number one, performance does need to be looked at in a relative basis, but we probably do that too much. And really where this comes from is it comes from the investment industry. So if you have a fund, if you're a fund manager and you have a fund or ETF, you typically have a benchmark. So you might have a very narrow focus. And of course, that narrow focus comes with a benchmark. And even if you have a wider focus, like a global fund, you, of course, are going to benchmark that against an index. And naturally, you all want to do this. And of course, in the investment industry, what is winning? To quote Charlie Sheen, what is winning? Well, winning, of course, is beating that benchmark. But a couple considerations around this. Number one, you as an individual investor have no benchmark. So while it may be satisfying, and certainly someone who likes to invest and enjoys the process, it is satisfying to beat a benchmark. We just have to remember that that benchmark, of course, is arbitrary. So it's arbitrary in that the returns of a benchmark over the long term don't necessarily have anything to do with your goals and what you need to achieve. It's arbitrary within the time limits we look at. It's also arbitrary because if the market goes down 25% in a year and your portfolio goes down 10%, from an investment standpoint, that's great. Right? You have outperformed significantly that benchmark. But that can be a very bad thing for you if it's a part of your investing journey where you can't afford to actually have that loss, particularly as you're approaching retirement or approaching another goal. A 10% loss in a portfolio, even if the overall market went down 25%, it's a really, really bad thing if you're saving up for a house and you're trying to use that money to actually pay for your house, because chances are you're going to be 10% short, right? So this is something that is interesting from an academic standpoint, but what it does do is it leads to a lot of poor decisions. And so I'd be very careful about just looking at performance on an absolute basis. So I'd much rather look at it against the performance you need to achieve your goal and, of course, the investment strategy you're taking. But what you can do with performance, and one of the reasons why it is something that's interesting to look at, is it's going to give you some more insights around your portfolio. And we want to be thoughtful about the different drivers that are going to impact our portfolio, because once again, it can put all of that data and all of the things you hear from the media and from financial institutions, and put that into context. And you can understand that, as we say in the bottom here, the different investment strategies are going to perform differently at different times. That doesn't make them good or bad necessarily, but it is just kind of a fact of life. And so if you understand the drivers of your portfolio performance, if you can attribute that portfolio performance to different things, then of course that's something that gives you a little more context and makes you a little more insightful about the way you're investing and that strategy you're taking. So there's really two, at a high level, two different things we can look at. We can look at kind of macro environmental factors that are dictating performance. So obviously we've had a bit of a pivot in the environment with which we're investing. So after a very long period of really low interest rates and really low inflation, we've seen the opposite. And that's going to impact different portfolios. And it's going to impact how you will perform based on how your portfolio is positioned. Just that change that we've seen last year. And one of the things that we've seen and has been talked a lot about, and I have talked about, is, we've seen this sort of seeming rotation from growth to value. And we've really seen that because of this overall macro environment we are investing in. So what happens, of course, when interest rates go up? Well, that's going to change the valuation that investors are willing to pay for different types of investments. And so what we've seen over the course of 2022, and what you may be seeing if you're looking at your portfolio, is a lot of some of these former high-flying growth assets where the cash flows that are generated by these companies happen far out into the future. We're seeing all of that revalued. So we're basically seeing repricing of those, far in the future cash flows, and they've come down. Right? The amount that investors are willing to pay for some of these companies has come down. So we have seen a pretty significant drop in growth. We've seen a significant drop in markets that are more aligned to growth. And the US market is a perfect example of this. US market that is more heavily made up of technology names, for example. We've seen the US market relatively underperform compared to everything else. So of course, depending upon where your portfolio and how your portfolio is positioned, that could have hurt you a lot during 2022, or it could have been to your benefit if you were in some of those more traditional value names. A lot of those value names that we see in the Australian market has done better. So things like financials, so the banks, which make up such a big part of the market. Now, once again, is this a good thing or a bad thing? Well, of course, it's from your own perspective. Will this continue to last into the future? I don't know. We will see. But what I will say is at least having that context will allow you to understand how your portfolio is positioned. We'll go through and do a live example of that and look at some different things you can look at. But right now, relatively, if you have more money invested domestically in Australia, you probably did better than if your portfolio is more tilted into something like the United States. Depending upon what sectors you're investing in, you invested a lot in technology, then you've probably done relatively worse. Now, once again, we want to look over the long term for this, and there was a huge run that these technology shares went on before that. There was a huge outperformance by the US, but really we're sitting in a pretty good shape as domestic investors in Australia compared to the rest of the world. And we're also sitting in really good shape because of currency movements. So because the Aussie dollar during 2022 was weak, that actually helped us. So that took away from investments we had overseas that reduce some of those losses. Now, just be careful with currency. And I do think that a lot of investors I speak to in Australia are very savvy about currency, as the Aussie dollar has kind of bounced around in a range over the years against the US dollar, against other currencies. Now, a lot of people think that the weakness that we saw in the Aussie dollar would in fact reverse itself. And lately, over the short term, it has. Seen the Aussie dollar keep going up. But just understand the source of those returns that you're actually getting. And that's why I liked looking at that chart earlier, where we could look at, was it capital gains, was it currency, or was it dividends? So it's important to look at. So we can look at those environmental factors. And that's really important to understand how our portfolio performs. The other thing we can look at is individual holdings and our own actions. So we can look at asset allocation, so higher level. Are you allocated in Australia? Are you allocated overseas? Are you allocated to bonds, which did very poorly, to keep money in cash, how that influences your portfolio? But also we can look at that individual holding level. So are you doing a good job of picking individual securities to go into your portfolio? And remember, that can be very hard. But if we can sit there and attribute, okay, was this just bad decisions, right? So let's say you're an Aussie investor picking individual shares and the banks held up pretty well. You just picked the worst bank. And it's good to look at this because it's also good to think about, okay, what were the drivers of you making that decision? And is this something that's actually sustained, or is this something that's going to repeat going forward? And maybe if you're doing a really poor job of picking investments in your portfolio, or if you're churning your portfolio significantly and chasing some of that performance, maybe it's time to go back and think about that strategy. Maybe you're not a stock picker. Maybe you're not the person that's trying to rotate into whatever the hot sector is. Maybe that's not your strength. Maybe instead it's better for you to go out and just invest passively and get overall exposure to the market. So, and look at your own actions. It's always a good time to go back and look at, okay, how much did you trade over the course of that year? And did those trades actually benefit your portfolio or not? So one thing that we tend to do as humans is that as soon as we sell something, so if to give that bank example again, so if I decide I'm going to sell CBA and buy Westpac, we tend to forget completely about what we sold and pretend like it never happened. But go back and look at some of your trading activity and say, hey, was that a good decision? How did CBA perform after you sold it relative to Westpac? And there are all sorts of studies out there, a very famous one from the University of California at Berkeley, that shows that most of the time when an investor sells one investment to buy another investment, the one they buy underperforms. And that, of course, is because we tend to chase performance. We tend to go out and chase things that have done well. And as I said, we do have a lot of reversion to the mean in investing, meaning that things that outperform will then typically go through periods where they underperform. And that can be a big problem for us as investors. That's where the actions we are taking are actually detracting from the returns that you receive. So once again, be careful with looking at performance, but when you are looking at performance, come up with something meaningful to describe why your portfolio underperformed. Did it underperform, as I said, once again, because of sort of larger macro issues, or did it underperform because of your own actions, which is a good insight to have because that can, of course, refine the approach that you're taking going forward, rather than just looking at overall performance and whatever, even if it's not contextualized, if you just sitting there and looking at how your portfolio did and making a statement, oh, it did well or it did poorly, because then, of course, if we don't understand why, we are more likely to go make decisions like switching our whole strategy and trying to churn that portfolio again. All right, so let's keep going. Sorry, I thought there was another question, but there was not. We're talking a little bit about asset allocation. So we all like to think, and this is kind of what we've been sold by everyone, we all like to think that what is going to matter the most for us is those individual holdings that we put in our portfolio. And people love talking about ideas, and I like doing it too, but people love talking about ideas like, should I invest in lithium? Should I invest in some thematic ETF? And we think that that's a really important thing, but more likely than not, the thing that's going to influence your long-term returns is your asset allocation. So once again, more allocation to growth assets that have higher expected returns over the long term, the higher the return should be in your portfolio over the long term. Same thing with defensive. We're going to get very defensive if we're trying to limit volatility or how much our portfolio bounces around. We're going to get lower returns. And the extreme example that I talked about, I believe on last week's webinar, was, of course, shares versus cash. So remember, asset allocation is very important. And asset allocation is definitely something that you need to review during these periodic reviews, because that makes sure that we are still on track. And there's a couple different levels you can look at. So I'll go through this slide, then I'll show some examples. But does your asset allocation still reflect your long-term plan? And in many cases, because of the performance of different things, it can deviate. Right? You could be overexposed to growth assets based on what you want to try to accomplish, or of course you can be underexposed. And that all has to do with relative performance within your portfolio. What are the parts that perform well? What are the parts that return poorly? It's always good to sit there and use this as an opportunity to look at that overall asset allocation. And in this case, we're just talking about asset classes. Once again, sort of growth assets, defensive assets, et cetera. But the other thing we can do is drill down a little bit more. And this is also part of that whole understanding, attributing your portfolio performance to the different things that are influencing it. But one thing we need to worry about as investors, of course, is risk. And there is overall risk. So that's volatility of your portfolio. And then there's the risk that we try to diversify away as investors. And what we're talking about there is single security risk. And that is the notion that you do not want to take too much risk in any individual security. So if you invested 95% of your portfolio in Tesla, well, you're probably not very happy right now, right? That could be an example of taking on too much risk. And what we see, of course, is over the course of time, is that you could be overly exposed to an individual security. Now, there's no right or wrong answer on how many things you should have in your portfolio. But we do want to make sure that we're not taking too much of that security specific risk, because the future, of course, is unknowable. And even a company that looks like it's doing great may not continue to do great. Enron was doing great until it didn't. For anyone, and I don't know how many people on here are in this boat, anyone who was investing a lot in crypto, well, that was doing great until it didn't. So it's about limiting that security risk. So going through and looking at the position sizes in your portfolio is something that's pretty critical. So personally, I try to keep individual holdings. And when I'm talking individual holdings, I'm talking about an individual share. Of course, something diversified like an ETF is different. I try to keep them around 5%. And I try to keep them around 5% for a couple different reasons that we'll talk about. But if I go back and look at my portfolio and see that all of a sudden something did very well, particularly in like a down year. So maybe, if you had an energy holding, for example, that did very well last year, and maybe the rest of your portfolio is invested in technology stocks, that all of a sudden could be an outsized position, right? And potentially you might want to do something about it. The other thing is, and we can look at sectors as well. We'll look at sectors when we go into the example, and I'll talk a little more about why sectors are important to look at. But once again, as a sector is doing well and you've moved a lot of either new money into that sector or just the natural appreciation of the price, you can be very exposed to that sector. And depending upon that sector, that might be something you want to dial back as well. But the other reason we want to look at individual position holdings is this notion of complexity. So once again, there's no right or wrong answer. Different people are going to be comfortable with different amounts of holdings, but portfolios over time can tend to get unnecessarily complex. And I see this happening personally sometimes with my portfolio, and something I try to take a look at. And generally, it's easy enough, especially if you're adding new money into your portfolio and you're going out there and buying new things, and you're doing what we always talk about at Morningstar, being very wary of selling things. And you're out there buying all these new things. All of a sudden, your portfolio can be very unwieldy, and it can become unwieldy for a couple different reasons. Number one, you can have a lot of overlapping exposure. And we did an ETF episode a couple episodes ago on the podcast where we talked about this, where all of this stuff seemingly makes sense, right? So you can see an investor sitting there. If we want to take an Australian example, the Australian market makes a lot of sense that you would sit there and say, okay, well, I'd like to invest a fair amount of my portfolio in an Aussie index fund. So I'll go out there and buy the ASX 200 or 300. Simple, I buy an ETF, they're cheap. Great, there I go. Now I want to invest in a couple individual Aussie shares. Well, I've heard good things about the banks, so I'll go buy the banks. BHP, well, it's the biggest company in Australia. Lots of good stuff about BHP. I'll put some money into BHP. Well, of course, you're getting huge exposures already to the banks at BHP, CSL, a couple of the other large companies in a very top-heavy index in Australia. And then you're going down, you're doubling down on all of those by buying the individual shares. So something to look at that overlap. Because once again, if we're trying to limit position size, and I'll show this on the example that I use, if we're trying to limit that position size, it's a very easy way to do it. And the other way that this happens a lot is if we start looking globally at investing. So it makes a lot of sense on a surface level if I sit there and say, okay, well, I do want to invest globally. So I'm going to go out there and buy a global index fund. So I'll go out and buy something that tracks the MSCI Global Developed Market Index. And I'll read about it in the literature, and it'll tell me it's in, 30 odd countries. And I think that's great. There's 1,500 securities. And I'll think, all right, really well diversified. That's great. Well, I want to get exposure to the US as well, because US is an important market. So I'll go buy an S&P 500 index fund. And everyone says that I need exposure into technology. So I'll go buy a NASDAQ 100, or I'll buy some smaller technology fund, maybe use an active manager with technology. Well, the problem with this, once again, when we start looking at overlap, is if we look at a MSCI developed market index, 70% of it's the US. So already, even though it's invested in all these different countries, what matters? Kind of the US, Japan, UK. Those are kind of the countries that are actually going to move that index. So you're 70% in the US. You go and you invest in the S&P 500, that's doubling up your exposure in the US on all these same big companies that are in the index. And then you go buy the NASDAQ, but the S&P 500 is 20+% technology. All of a sudden, you're seeing a lot of overlap again. And you think you're doing the right thing because in isolation, each one of those securities makes sense. You're not spending a lot of time really looking at what's in them. So you think you're diversified, but you're really not. So you just have a lot of US exposure, a lot of tech exposure. And if that's what you're looking for, fine, but just understand what's happening and think about what that overlap is between different securities. Because once again, it can push those exposures up to a higher level than you want. So certainly country exposure, sector exposure, and even individual security exposure, like Apple, for example, makes up such a big part of all of those indexes. You could be very exposed to Apple without even knowing you are. The other thing where portfolios can be really complex, as I was talking about, is that if you're naturally going and continually adding new positions to your portfolio, well, all of a sudden you can get all these tiny holdings that really mathematically can have no influence over your outcome. So I kind of talk about that 5%, something that I look at, and I certainly have positions lower than 5%, but if you're sitting there and you have 0.1% of your overall portfolio in an individual share, nothing that share is going to do is really going to influence your outcome. And so is having those additional holdings beneficial, or is it just confusing that overall picture? So it's about making sure you're right sizing those positions and keeping things as less as simplified as possible so that you are not spending all of your time managing this overly complex portfolio, not really understanding what's happening. And that, of course, leads us to rebalancing. So I'll spend a minute on rebalancing, and I'll get into some of the questions that have come through so far. So rebalancing, of course, is simply getting your portfolio, which is out of line, back into line. So you can rebalance at an overall asset class level based on performance. You could have too much exposure to shares and too little exposure to bonds, for example. Simply rebalance by selling your winners, buying your losers to get that overall asset allocation back into line. You can rebalance out of certain positions. So certainly a position that has become too big of a part of your portfolio where you're taking on too much individual security risk can rebalance that way. Just remember one thing about rebalancing, depending upon your tax situation, depending upon the account with which where this is, in super, outside of super, for example, rebalancing has some issues. And number one, there are tax issues. So of course, by selling your winners and buying your losers, you potentially are exposed to capital gains tax. Not a great thing. We want to minimize our taxes. So it is important to rebalance in a smart way. And there's two different ways we can do this. Number one is making sure that we are not rebalancing if things get a little bit out of whack. Right? So when I was sitting there talking about 5%, doesn't mean you're going to go sell something that's 5.5% of your portfolio, right? We want a little bit of a buffer, realizing that, of course, there's going to be volatility along the way. Different positions are going to perform in relatively different ways. So one, it's not getting too aggressive with that rebalancing. And a lot of people, what they'll do is they'll put a rule around it. So they will only rebalance if something is, let's say, 10% out of whack in terms of their portfolio. I just give a 10% example, by the way, of that individual security, but more on an asset class level. They might not rebalance then, just wait naturally for the market to correct itself, knowing that paying those taxes is going to be something that's poor for our overall outcome. But the other way, you can think about more creative ways of rebalancing. So of course, if you are continuing to save and invest, or even if you're in retirement, you're generating income in your portfolio, and you want to reinvest some of that income that you're generating, there are ways, of course, we can make adjustments on that. So we don't actually have to sell something in order to put more money into, in my example, like into bonds, for example. So there are ways to be a little more creative about that rebalancing. So just make sure that you're thinking about those transaction costs. And remember, there's all sorts of different transaction costs. There's the buy-sell spread, as well as simply what you're paying for brokerage. Think about trying to minimize that if you can. In some cases, of course, that's not possible. You have a very large portfolio, then of course, and you're saving relatively small amounts into it, it becomes very difficult to rebalance that way. But if you're just getting started as an investor and the amount that you're saving and investing every year is a good chunk of what your overall portfolio level is, which a lot of young people experience, then perhaps you can rebalance simply with that new money. If you're putting 10, 15, 20% of your portfolio value into it every year from savings, you can basically rebalance any way you want just by directing those new contributions into different places where you might have under exposure. All right, so we've got a couple. Oh no, I don't know what I just did. We've got some questions, so we'll try to go through some questions. So Lisa, is it better to tolerate volatile returns rather than churn the portfolio chasing higher returns? Well, it's a good question, Lisa. The answer, of course, is it depends. But I do think that you need to think about what are the risks to you achieving your goals. I think people fall into different camps there. Tolerating volatility is investing, right? What you don't want is volatility. For most investors that have longer term time periods, it's really not volatility that's the risk. So how much your portfolio bounces around year to year probably don't matter a whole lot if you're 40, especially if you're investing for something like retirement when you're 65. So in that case, volatility is not really the concern. I think the two concerns and why you want to rebalance is not to eliminate that volatility, but it's to rebalance based on individual security risk. You're taking too much risk in an individual security where that company went bankrupt, or that company had a situation like Tesla's gone through where it has fallen significantly, that is going to prevent you from achieving your goals. So that's one reason to rebalance. And then the other reason, of course, is that the portfolio no longer looks like what is needed in order to achieve the returns that you need, right? So, and this is an extreme example, but if you need to achieve a 7% return a year, and somehow you go look at your portfolio, you haven't looked at it for years, and somehow it's 80% bonds, well, it's going to be very difficult for you to get to that level. And so that's obviously an extreme example, but it's just making sure that your portfolio is still aligned at that asset class level in a way where you are likely to achieve the returns that you need. So I think that's a really good way to look at it. So Paul has a question, more of a comment. So 5% for each individual stock, average amount of stocks, 15, 75% seems too high. Yeah, I mean, listen, 5%, what I would say is 5% is sort of the limit that I would put in an individual security, but that's me, right? So once again, I was trying to use a personal example. I think for a lot of people, maybe that is too high. And, a lot of positions that I have are certainly below that. And I do hold more than 15 securities, but yes, that could be too high. So I think it's just looking at, okay, what are the types of investments you're investing in? If you're investing in things and anything can happen, of course, but more likely than not, have more stability, less business risk, for example. Once again, anything can happen. Then potentially maybe some of your larger positions, you would get to a bigger level, whatever that means for you. But it's really looking at, okay, yeah, what's your overall comfort level of that particular investment, and how much single security risk is too much. Conversely, what I would say is there are a lot of people that hold way too many investments, and this is a big debate, right? It's a big debate between should you run concentrated portfolios or should you not run concentrated portfolios. Concentrated portfolios, of course, mean that those individual securities you pick have a bigger influence. If you run a portfolio that is hundreds of securities, well, you're kind of a closet indexer then. Maybe you should just go for the index. But yeah, we want to make sure that those positions are not too small. As Rodney's making his comment, his problem, he has really small positions. Well, yeah, there's a couple of things that I sort of noticed in my portfolio that no matter what happens to them, they could triple in value next year. It's not going to impact me at all. Perhaps that's way too small. So we've got a question on, can you talk about some strategies for saving on capital gains as you come closer to retirement? Yeah, well, obviously I'm not a tax professional. That is something that's important to say. But yes, that is a problem, of course. Now, hopefully, as you're getting closer to retirement, you do have those assets in accounts like super where there is a tax advantage. But yeah, that is potentially a problem. So I think it's just being very smart about the way that what you are selling. And there's a lot of things you can do in Australia in terms of the different options that you're given over what you can sell and what you can't sell in order to minimize your capital gains. You, of course, try to offset them. If you have some losers in your portfolio, you try to offset some of those capital gains as well. So that's something you can use. And look for other ways, of course, to get money out of your portfolio. So a lot of people like to use income. So, of course, obviously you're paying taxes on it, but they're looking at dividend income that's generated, et cetera. But at the end of the day, hey, it's hard to completely, of course, eliminate taxes, but it's just being smart about them, trying to minimize them as much as possible. So Damien says, with positions that have become very small due to severe share price drops and some lessons hopefully learned, at what point do you say it's no longer worth selling, or is it always better to clear out a disaster such tiny positions? I think that two things that you need to think about is that many people do become overly fixated on certain positions that they have, particularly losers. And, there is this aversion to losses, right? So that we do not want to accept and turn a paper loss into an actual loss. We do not want to accept that we made a mistake. We're all going to make mistakes, right? With different investments we have. So I guess I wouldn't become too emotionally attached to that, too emotionally attached to trying to get back to break even. If this position is really going to have no influence over your portfolio, realize that there is a good thing about selling losers. And of course, it's what I was talking about before. It's the ability to offset some of those capital gains you have. So try to think about the good things. Try to think about, will this thing influence your portfolio? How much, bandwidth is this taking up? Just you focused on a couple losers that are very, very small sizes in your portfolio, and how much that overall complexity is making things harder, like everything we're talking about today, to do and to actually manage your portfolio. So I did want to quickly, we've got a couple more questions. I did want to quickly use an example of a couple of things we can look at. So I've just run a portfolio through X-Ray on our, actually sharing this, that's good, on X-Ray on Morningstar Investor. So once again, we talked a lot about asset allocation, looking at overall asset allocation, comparing that to your goal, but a couple other things we can look at. Of course, we can look at single country exposure, which is something you might want to consider. But sectors are an interesting one. And we did have a question in here about sectors and looking at overall sectors. So let me just find that, because you talk about strategies for saving. Oh, we already had that one. A certain sector is doing extremely well and one wants to catch out. How do you do that without changing the investment strategy? Yeah, well, remember, the investment strategy doesn't necessarily have to be about a certain sector. Sectors do well, sectors don't do well. But where I would say it comes in from a sector perspective is it comes in from the attributes of that sector. So what we've done at Morningstar is we've divided those stock sectors up into three different sort of super categories. So we've got cyclical. So remember, cyclical shares are going to go with the economy. So as the economy does well, these companies will do well. Big one for Australia is basic materials, right? So those are the ingredients into a lot of things that are built, for example. So iron ore is a good example. Obviously, it goes into steel. What does steel go into? Well, construction, infrastructure, everything else. Thinking about those different cyclical sectors and how they're going to perform in different economies. sensitive, kind of in between, defensive. These are things that should do well no matter what's happening in the economy. And I would say your strategy is more defined around what are the sectors that you are comfortable holding, and understanding that, personally, I prefer things in the defensive sector, which, as you can see, there's an overexposure to, because I like the fact that there is less volatility in those shares typically over a whole business cycle. Doesn't mean they'll do better, right? But they'll bounce around a lot. And that's something that helps me sleep at night. So think about sectors in terms of where those exposures are, and think about how they will impact your portfolio depending upon how the economy is going. So this can be another thing where we can attribute returns. And the returns that we achieve in our portfolio, we can attribute those to how we are allocated across different sectors. So something good to look at. The other thing I would look at, we talked about style. So where are you from a value to growth perspective? Where are you from a large cap to small cap? So once again, large cap shares, typically less volatile. You typically, over the full cycle, get lower returns from large caps. Now, that hasn't been true lately, but if we go back and look over a longer investing period, so see where you are from a style perspective and how that might explain some of the returns you get. And then, of course, I talked about portfolio holdings. So one neat little trick we have in our X-ray is I can look at the top holdings, right? So I can look at position levels, right? Weights for individual positions, but I can also look at stock overlap. And this is where we can get in that situation where you might own a couple ETFs. They're all invested in the same thing. So I use Apple as an example. If we look at Australia, well, this is where you can be very exposed to BHP, right? About 10% of the local index. You go out and buy that as a position as well. All of a sudden, it's a big exposure. So what this will show you is individual holdings. I don't show you any funds or ETFs that also have the same holding, and it can give you that overall position, right? So there's nothing on this little dummy portfolio I set up that's too far out of whack. But at the end of the day, you could think you've got a 5% position in Intel, or maybe this is 10% because you've loaded up on a lot of ETFs or funds where Intel is a large holding. So that's something that's important to look at as well. So we've got a question from Eleanor. Do you include ETFs, bonds, and equity stocks as part of your 15 to 20 holdings maximum, or just 15 to 20 equities? I was looking at individual equity holdings, and like what I will say is I do have different portfolios that some I invest in ETFs, some I invest in individual shares. I'm really looking at those individual shares as a portion. So it's that single company risk, right, that I'm worried about. With an ETF, of course, you are diversified. You are more diversified. Just be careful because sometimes you can have very large holdings in those. So that's really when I'm looking at kind of the maximum amount of shares. So around 20 shares generally diversifies away 90% or so of that single company risk in your portfolio. But no portfolio, there's no right answer to any of this. So it's kind of what you are exposed to. I would say the second part of the question, Eleanor, how many ETFs or bond companies, we'll talk about that in a second, should we have exposure to? Remember, an ETF, what I look out for is just the overlapping ETFs, right? So when you are investing in lots of ETFs that have overlapping holdings, that's probably not a great thing, just because there's an opportunity to simplify your portfolio if there's a lot of overlap. So that's something that I would look at. Let's see. So Peter's saying, where are bank hybrids positioned in asset allocation? Are they fixed income? Yeah, so hybrids obviously has both equity and debt characteristics. I would consider them more defensive assets. So you're probably going to get more volatility than holding an individual bond, but you are going to get more income, of course, than most individual bonds. But I would classify those more as defensive, Peter. And then, yeah, just the one other question that Eleanor had is bond companies. So if you're talking about the individual companies that you own a bond in, well, once again, that can be single company exposure, right? And what you're exposed to, of course, is that company defaults. But of course, things like treasuries, things like Aussie government bonds, things like that are very different. So you can be very exposed to the country, but of course, depending upon the credit rating of that country and the chances of default, I wouldn't worry too much about that necessarily. All right, we are at the end. If anyone else has any questions, send me an email. It's mark.lamonica1@morningstar.com. I think I got through most of the questions. But anyway, I'll be back next Tuesday to do this again. I hope everyone has a great rest of the week. And we do have a webinar looking at a market outlook for next year, Tuesday evening. So if you want an invite to that, just send me an email. But thank you guys very much for joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.